Good morning, everyone. Today I'm going to share with you some insights from the practical experience BSC teams have been gaining over the last years in Armenia, in Georgia, in Kyrgyzstan, and in Serbia. In these countries, we are currently supporting more than 20 financial institutions in the field of agricultural finance. And this has been made possible thanks to the financing provided by the German government through KfW Development Bank, and in Georgia, also with financing from the Swiss government. In my presentation, I will try to answer the following 4 questions. First, why value chain finance? Second, when is it feasible to implement a value chain finance scheme and when not? Third, what are the components of an effective value chain finance concept? And fourth, what matters most for a successful implementation? So let us move to the first question. In value chain finance, 3 stakeholders enter into a cooperation: the farmer, the aggregator, and the bank. Why would they want to cooperate with each other? Farmers can benefit from an improved access to finance. Aggregators, which in this presentation can be either input suppliers or food processing companies, their benefit is support of business growth. And banks. Banks can benefit from obtaining an additional sales channel and from subsequent cost reduction. When I mean banks in this presentation, it could be also referred to MFIs. This is not very innovative. All these advantages I mentioned can be found in any textbook. And what is important here to understand, the textbook is a textbook, but the reality is a reality. And the reality is very different. So as in agriculture, the amount of those advantages or the amount of harvest we can get from such a scheme is very much depending on the location and on the timing. And what I mean with this, we will discuss in the next slide when we speak about the feasibility. The feasibility at country level. We want to know how developed are the 2 sectors, finance and agriculture. Low outreach of a financial sector stands for low market saturation, and high means high saturation. A well-developed agriculture sector is marked by a high level of integration on the top right corner. So if we combine these criteria now, we can come up with 4 possible scenarios. Let's start with the worst case first. That's a country with a poorly developed financial sector and a poorly integrated agricultural sector. Basic direct lending schemes, they can work here, but for value chain finance, this would be a no-go. It's too much effort and too little output. 10 to 15 years ago, most post-Soviet countries, they would have qualified for such a rating. Now let's look at the best case scenario, which you rate with 3 stars. Here, most likely value chain financing is already flourishing. We would rate a country like Turkey in this category. 2 stars, well feasible. These are promising conditions for an intervention with a project. Serbia would come close to such a rating in our view, though there are some specifics that make it difficult to give a clear-cut rating here. And 1 star. This is just feasible. It's a tough case due to high market saturation on the financial sector side and a low level of integration between the aggregators and the farmers. Makes it very challenging to establish here a value chain finance scheme, but still possible. Armenia, Georgia, and Kyrgyzstan fall with some nuances between them, all in this 1-star category. So what can we learn from this? Well, most important, it is to understand where the challenges are for a given market prior to implementation in order to be able to properly allocate the resources and manage expectations also regarding output. So you want to know at what level of difficulty you start this before you go into it. Now let us have a look at the second section, related to the feasibility analysis of the subsector. So at the level of the subsector, we could do a full-fledged feasibility analysis, but it would be very labor-intensive to collect all the data. And to be more efficient, we have reduced the scope of analysis to the very minimum needed. And we do this by focusing on the most critical link in a value chain finance scheme, which is the aggregator, the partner. For the lender, the partner is so important as it serves as an agent to assist the bank in distributing their services in a more cost-efficient manner. And there are two ways of selecting now a partner. You can do it externally or internally. If you do it externally, it means you are doing a full-fledged market analysis. And here with the aim to select the best in class. You have a full choice, that's great, but at the same time also you have a very high effort in collecting all the data and analyzing them. So on the other side, you can do an internal analysis by utilizing the bank's own database, and this lowers much the effort collecting data and analyzing them. It has also the advantage that the existing relationship to clients will make it easier to win their interest to participate in the scheme. And so that's why we normally recommend to start with the second option, to first look at the internal database. And now we have here 4 criteria we would see to be rated. The first one is the aggregator strength and the motivation. The motivation is the most important of all here. And for motivation, it's important to understand what are the pain points actually the aggregator is facing in the current work with farmers, with banks. How can they be addressed in design of this financing scheme? For example, when you have a supplier who sells much on credit and uses his own working capital for that, he's normally more motivated to introduce a lending program than another one who only accepts the cash at the moment of sales. But this is just one example. The second criteria we look at is the farmer-aggregator relationship. And here it's important to understand how much they are married with each other or not. So the concrete evidence of an existing formal relationship is quite a good sign here. For example, if there exist take-off contracts, that's a big advantage already for setting up a scheme. It makes it much more feasible and easier. And then the smallholder cluster size. So we would like to see not less than 100 farmers per aggregator that can be tapped into as potential clients for the financial institutions to justify the effort for setting up a scheme. And the last of the 4 points is the subsector development prospects. Well, it's quite straightforward. Basically, we talk here about the growth rates that can be expected from a given subsector. So as a result of all this, we get a prioritization of the potential partners, and we can start negotiations with the highest ranked aggregator subsequently. And with this, the feasibility analysis is completed, and we move now to the next section. It's the concept design. In this section, concept design will focus on the product and the delivery scheme. And here you can see an example for a product that was designed by BFC for a rural lender in Armenia a few months ago. And then there was a pilot project with this product. It was very successful, and it prompted the lender to replicate the scheme with 3 additional partners right after. And the partnering aggregator here is a leading supplier of agricultural inputs that's located in a very fertile area in the Ararat Valley. So the customer base of this aggregator is 400 permanent farmers and about 3,000 to 4,000 retail on-the-spot customers each year. And the average loan amount disbursed here was €400, with the maturity is mostly within the season for the financed crop, so less than 12 months. And the loans, they were used mostly for inputs, seasonal inputs, seeds, fertilizers, plant protection, but some also for purchasing fixed assets like irrigation systems and so on. And the farmers are mostly smallholders. They have a total land under management. It's not exceeding 10 hectares. What were the key advantages of this product in the local markets? First, fast loan decision making. No site visit, no collateral, minimum document package. they were reducing transaction costs of the customer and the lender, and of course adding convenience for the customer. And the second big advantage were lower transaction costs in terms of the pricing. So there's no interest charge. That's quite innovative in the market for clients up to loans up to a 6-month maturity. So if you take a loan up to 6 months, you pay no interest, only the disbursement fee of 3%. And if you take a loan to 12 months, up to 12 months, you would pay 6% per annum. And how is it made possible? Well, there's a special compensation fee of 5 to 6% that is being charged by the bank from the supplier. That works similar to a wholesale discount. Let us move on and look for the same country, Armenia, with the same case related to this product and a supply-driven delivery scheme. So how the delivery scheme is structured. We have here the customer journey. I want to go with you in 5 steps. So here the customer comes to the shop of the input supplier and he learns about the lending program and of course the offer of the shop. He will take a preliminary invoice from the shop and on the planned purchase, and then he will walk to the next bank branch. We selected here a place where the next office is 5 minutes from the walking distance from the shop. He applies there for a loan. And the data collection, the credit analysis, decision, everything takes 30 to 60 minutes. And then once the loan is approved in the 4th step, he's getting a loan agreement signed and a confirmation letter. And with that, he returns to the shop in the 5th step and basically is taking out the goods. So the total process here of purchasing the inputs and getting the loan has been taking these 5 steps and a total time of 2 to 3 hours. And in this market, in Armenia, this has been a significant improvement and made it attractive for clients to use this. And another key advantage of this scheme is that the borrower does not receive any cash. So the payment is made directly to the shop's account. And this is very important because it guarantees that the loan purpose is properly observed. And for a country like Armenia and in the region, the other countries would be similar. This is quite a big matter because there's a very high share of loans which are disbursed in cash to farmers where the loan purpose is not properly followed. And monitoring is also expensive to monitor this, and it's very difficult to monitor this. Lower cash operations also mean lower operational risk for the bank. Another important benefit of this scheme is again that the partner, so the input supplier, has been freed from dealing with himself with labor-intensive provision administration of credit to his clients. So in this case, the partner has employed a separate person only dealing with credit provided to buyers. And to administer this was quite labor-intensive for him. Now, let us move to another scheme, and this is the process of a driven delivery scheme from Kyrgyzstan. Okay? Here we deal with the largest sugar-producing plant of Kyrgyzstan, which is near the capital Bishkek, and it works with 3,000 sugar beet farmers, buys every year the whole harvest from them, and is quite motivated to increase the quantities of high-quality raw material. And the main pain point for the factory has been that there was no external financing program which could be integrated in their own support program of supporting farmers with inputs or with knowledge. And how is the scheme being set up? There were 3 main contractual arrangements between the parties. So the first on top is the general partnership agreement between the sugar plant and the bank. Then the bank has special loan agreements with the farmers, and the sugar plant itself has guaranteed purchase contract with the farmers. So these 3 contracts, they form the framework, and the loan disbursements here have been made in tranches, also in order to reduce interest payments for the clients, so they get the money when they use it, in 3 tranches, out of which 2 were non-cash tranches, which is again quite important and reduces risks, and the last one was a cash tranche. The repayment after the harvest has been made directly by the sugar plant to the bank's account. So again, reducing cash operations. And now, what were the main lessons learned from this scheme here, under which in the 2015 and 16 seasons were served 137 farmers with an amount of 218,000 euro so far. So there were mainly 3 lessons I would like to mention. The first one is that building trust between the farmers and the processor is very essential, and it requires also patience. And the second is that the knowledge transfer from the processor to the farmer has been quite important to increase productivity at farm level. So this is a non-financial attribute which has been quite important to make the scheme well working. And the third, that's highly critical for the success, is a high buy-in of the branch staff to deal with these farmer suppliers. So if the branch staff is not really on it, then it is difficult to get it running. So let us now move to a few aspects on implementation. And basically, I want to talk about two things here. These are three: the documents, training, and the planning. About the documents and policies. Here, we look at a set of documents, and they form the base for the cooperation between all the three players. And it's quite essential that they are properly worked out in order to reduce operational risks and make the implementation happen smoothly. And for this, in our experience, it has been quite important to set up a project coordination group with a very experienced project coordinator who can take care of all of the detail, but also make sure the external and internal communication is properly handled and the output is good. We will not speak about each document here, but the most important is the general partnership agreement out of these, so between the aggregator and the bank, which basically defines all the operational details, the roles, responsibilities, rights of all the parties, and that is kind of the constitution of the whole scheme. The second step in implementation here is a training. This is very important, and the most important of the three trainings we're delivering is the branch staff training. That's the branch staff training for the front office staff. Is not just to explain them what has changed now and what's new with the scheme, but more important is again the motivation. So we often face a natural internal resistance to these changes, like people saying, this is not going to work. We did it all the time this way, and so on. And you have to take these doubts and hesitations very seriously and work with them through. Otherwise, if the people feel not taken serious and are not convinced, they will become the stumble stone and eventually a deal breaker for the whole project. It only is going to work if they believe in it. Well then, head office training is clear to get everyone on the same page. All departments are informed about this. And quite important also is train the partner staff. So the staff of the partner, in particular in a supply-driven value chain scheme. So those are people who sell in the shop the inputs. They should know the basics about this program. So the document flow, certain risks and so on, how the customers are selected in order to kind of smoothly cooperate with the bank and make sure the clients feel that communication is aligned at all stages with them. Okay, we are almost done. The slide about planning here. So we have discussed three phases, which take a total of 9 months. We had feasibility analysis at the beginning. So if we start at 1st of October, we basically have a concept design, which will be finished in the second project quarter, so by the end of the year. And then it allows to start a pilot scheme just on time with the spring season, finishing in summer. These assumptions have been made, this planning has been made based on the assumption that there is an experienced expert involved who is familiar with the matter and can give guidance and some coordination support. Now, let me conclude with this last slide. Agricultural value chain financing holds quite promising results. And at the same time, implementation can be challenging. And to master those challenges, we should take into account the following 4 points. So the first is, why value chain finance? This will only work if the benefits are shared and they are clear to everybody. So on the side of the farmers and aggregators, value chain finance can add a new quality to the relationship and strengthen the business of both. And on the side of the bank, cost reduction as well as credit and operational risk improvements are the key motivators here. There are many other advantages which should be built into the scheme, and building those advantages into the scheme and their relevance, that actually defines very much the likelihood of success. The second, the feasibility analysis. We have seen that value chain finance is feasible almost everywhere, but the effort needed here can differ significantly depending on the local context. And the most critical step at this stage is the selection of an appropriate partner. Here it's important to understand that motivation is key, and trust. And motivation and trust, they are not just given, but they need to be developed through adequate communication approach. And third, how does a workable concept look like? What are the ingredients? Well, it is as simple as this. When the product and the delivery scheme design, they form together one seamless piece, which addresses the pain points of all stakeholders, particularly the aggregator and the farmers, then you're on the right side and the product will have success. So addressing pain points properly with the concept. And the last, about implementation, how to achieve the excellence. Well, it's easy to say. It's just good project management. And if I would have used one word, then I would use the word clarity, which is very important to reduce the complexity which is naturally in the scheme. So clarity matters. It's clarity in terms of the objectives and expectations for all stakeholders. It's clarity related to the assignment of tasks and roles to stakeholders. It's clarity with regard to the communication, to the products, for the clients, to the documentation, and so on. And we believe at BFC that if those 4 points are followed properly, then value chain financing can be done successfully, even in those one-star rated countries, as our experience has shown. Thanks for your attention.